Ethereum has always been more than just another cryptocurrency. From the very beginning, it positioned itself as the foundation of an entirely new digital economy. While Bitcoin focused on being sound money, Ethereum became the infrastructure layer powering decentralized finance. NFTs, stablecoins, and thousands of applications running on-chain. That is why whenever Ethereum shows weakness, the market reaction is always intense. Investors don't just see price fluctuations. They question the future of the entire ecosystem. Recently, Ethereum has gone through a period of increased volatility. Price corrections, slow momentum, and relative underperformance compared to Bitcoin have created uncertainty, especially among short-term traders. Many are asking whether Ethereum is losing relevance or whether the market is simply misreading what is happening beneath the surface. To understand this moment, price alone is not enough. We have to look at behavior, structure, and how capital is moving across the broader market. One of the biggest reasons Ethereum feels under pressure right now is because it is being traded as a macro-sensitive risk asset. In the current environment, liquidity conditions matter more than innovation in the short term. Interest rate expectations, U.S. economic data, and shifts in risk appetite all influence how Ethereum is priced on a daily basis. This does not mean Ethereum's fundamentals are broken. It means timing has taken control of the narrative. When markets become uncertain, capital becomes defensive, and Ethereum often sits right in the middle of that transition. Another factor distorting Ethereum's price action is capital rotation. During periods of uncertainty, investors tend to move capital toward Bitcoin first. Bitcoin is seen as the safest asset within crypto, so it absorbs attention and liquidity early. Ethereum, on the other hand, tends to lag during these phases. This behavior is not new. In previous cycles, Ethereum often underperformed Bitcoin during uncertain or early stages, only to outperform later once confidence returned. Short-term weakness does not necessarily signal long-term decline. It reflects how capital prioritizes safety before growth. Before the recent pullback, expectations around Ethereum had become crowded. Many investors priced in rapid scaling improvements, strong institutional adoption, and long-term supply reduction through staking. When expectations rise faster than reality can confirm, markets correct. That correction doesn't invalidate the thesis, it resets it. What we are witnessing now is not a rejection of Ethereum, but a repricing of timelines and confidence. Ethereum's volatility also feels different today because the asset itself has changed. Ethereum is no longer proof of work. It is proof of stake, yield-bearing, and deeply integrated into financial infrastructure. That makes it more complex to value. It is influenced by yield expectations, capital efficiency, and institutional risk models. As Ethereum becomes more mature, its price behavior becomes less explosive and more sensitive to macro conditions. For retail investors, this transition can feel confusing. What once moved on hype now moves on structure. Gas fees are often brought up during periods of Ethereum weakness, but this narrative is frequently misunderstood. High fees are not a sign of failure. They are a sign of demand. At the same time, scaling solutions and network upgrades are actively changing how activity and value are distributed across the ecosystem. Markets are notoriously bad at pricing transitions. During these periods, uncertainty rises even when long-term direction remains intact. This brings us to the most important question. Is Ethereum breaking down, or is it being repriced? A breakdown would involve long-term capital exiting, relevance fading, and structural damage. A repricing involves expectations being adjusted, leverage being flushed out, and patience being tested. Right now, Ethereum's behavior aligns far more with repricing than breakdown. Long-term participants are not aggressively exiting. They are waiting, and waiting phases are often the most critical parts of any cycle. Ethereum feels heavy because it sits between narratives. It is not purely digital gold, and it is not pure speculation. It represents infrastructure, yield, and utility, all at once. Assets in this position are harder to trade emotionally. They require conviction, not excitement. This is where impatience builds, and impatience is rarely rewarded in financial markets. At this stage, Ethereum is searching for acceptance. Short-term conviction is weak, but the long-term thesis has not changed. These moments are uncomfortable, but historically they are where future trends quietly begin. Weak positions are shaken out, strong hands build slowly, and price stabilizes before direction becomes clear. Ethereum does not need hype right now. It needs time, confirmation, and discipline from those watching closely. As the market moves forward from this phase of uncertainty, the most important thing to understand about Ethereum is that its next major move will not be driven by hype or sudden excitement. It will be driven by alignment. Ethereum rallies have always required multiple conditions to come together at the same time, and right now the market is in the process of slowly moving toward that alignment. One of the strongest forces shaping Ethereum's future is staking behavior. Unlike previous cycles, Ethereum now has a built-in yield component. This changes investor psychology completely. Long-term holders are no longer forced to rely purely on price appreciation. They can earn yield while waiting. This reduces panic selling during downturns and naturally tightens liquid supply over time. When large portions of ETH remain staked and inactive, it limits downside pressure even during volatile conditions. Institutional behavior also plays a critical role here. Institutions do not chase short-term price swings. They observe stability, regulatory clarity, and liquidity conditions. Ethereum's growing integration into traditional financial structures makes it increasingly visible to this type of capital. However, institutions move slowly. They wait for confirmation, not excitement. This means accumulation often happens quietly, during periods when retail interest fades. Another important factor is the broader Ethereum ecosystem itself. Decentralized finance, stablecoin settlement, and on-chain activity continue to operate regardless of short-term price movements. Usage does not disappear during corrections. In many cases, it grows quietly in the background. Markets tend to undervalue this persistence because it is not immediately visible on price charts. But over time, sustained usage builds pressure beneath the surface. Scaling improvements and network upgrades also play a long-term role in Ethereum's valuation. These changes are not designed to create short-term price spikes. They are designed to make Ethereum more efficient, more scalable, and more competitive over time. Markets often struggle to price long-term infrastructure improvements accurately, especially when short-term macro conditions dominate sentiment. This disconnect creates periods where price lags progress. From a market structure perspective, Ethereum does not need to move aggressively higher to be healthy. Sideways consolidation, gradual recovery, and reduced volatility are often stronger signals than sudden pumps. Professionals look for acceptance, not excitement. They want to see price hold key levels, attract buyers on pullbacks, and avoid sharp emotional reactions. These behaviors indicate that confidence is slowly returning. It is also important to address the idea of timing. Many investors are obsessed with exact dates and price targets. Ethereum does not move on calendars. It moves when conditions allow. Liquidity needs to stabilize, macro uncertainty needs to ease, and risk appetite needs to return gradually. When that happens, Ethereum tends to move faster than most expect. But only after patience has been tested. Could Ethereum still experience more volatility? Absolutely. Markets rarely move in straight lines. Short-term pullbacks, false breakouts, and periods of frustration are all part of the process. What matters is not short-term noise, but long-term behavior. As long as long-term holders remain engaged and structural demand remains intact, volatility becomes a feature, not a flaw. For investors watching from the United States and other mature markets, Ethereum now represents something different than it did in the past. It is no longer just a speculative bet. It is a developing financial layer. That means expectations need to be adjusted. Returns may not be as explosive as early cycles, but sustainability becomes more important. Ethereum is transitioning from a growth experiment into a financial platform, and that transition naturally changes how price behaves. The biggest mistake investors can make during this phase is emotional decision-making. Selling out of frustration or buying out of fear of missing out often leads to poor outcomes. Ethereum rewards those who understand cycles, manage risk, and remain disciplined. It punishes impatience and overconfidence equally. What we are witnessing right now is not the end of Ethereum's story. It is a pause. A necessary pause. One that allows excess expectations to reset and stronger foundations to form. Every major expansion phase in Ethereum's history was preceded by periods like this, where conviction was tested and attention shifted elsewhere. As the market continues to evolve, Ethereum's value proposition becomes clearer, not weaker. Infrastructure does not need excitement to matter. It needs adoption, reliability, and time. Ethereum has all three. Price will eventually reflect that reality, but only after the market finishes questioning it. The real question for investors is not whether Ethereum will survive volatility. It is whether they can remain patient long enough to benefit from what comes next. Because in markets, opportunity rarely announces itself loudly. It forms quietly, while most people are distracted.